Hello and welcome to Market Domination. I'm Julie Hyman. That's Brian Sozzi in for Josh Lipton. Today, live from our New York City headquarters, we are giving you the ultimate investing playbook. We'll help you tune out the noise and make the right moves for your money.
All right, from today's top investing stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we'll dig deeper into everything you need to know for the last hour of trading.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We'll get some prints this week, CPI and PPI. If it remains a little sticky, the Fed may be on hold longer than people think. And remember, we've reared an entire generation of investors that think they should only buy stocks if interest rates go down. That's not the case. We could see some, again, near-term volatility to the downside if the Fed doesn't cut because everybody thinks it should cut, but we don't think it needs to cut.
We honestly are expecting a recession still, where we might be one of the last people still seeing those signs, but really this early weakening in the labor market, the unemployment rate can rise relatively quickly. So we are still expecting to see that by mid-year, and we might be looking at a 5.5% unemployment rate by the end of the year.
I think it's a cocktail of then it breaks out above the highs, and how can it go? Well, sky is obviously the limit. My guess is it's going to go probably like 100,000 or so. That will be your first sort of major milestone.
We've got an hour to go until the market close. Let's show you where we are and how we got here. Starting with the major averages right now, we've got the Dow up just about 39 points, call it just about 0.1%, trading higher today, but really you could call it little change, perhaps as investors are waiting for that big CPI print tomorrow morning. The S&P, little change to the downside. The Nasdaq Composite off 0.25%. Something I do want to highlight today is the action in the S&P Equal Weight Index. That's right. If you look at this, and assume everything is equally weighted, not market cap weighted like it is in the S&P 500, we are seeing this push a little higher today and also reach another record. Why is that significant? Well, we continue to see a bit of a broadening of the rally here beyond large cap tech, beyond the Magnificent Seven. Let's take a look at the sectors as well before I toss it back to Brian here. If you look at all of the sectors in the S&P 500 today, you've got industrials and real estate that are weak, as well as tech here, so that's interesting and something to keep an eye on. On the flip side, when we look at what is up the most today, we've got materials and energy and consumer staple SAAs that are rising.
Julie getting all fancy with that equal weight shout out on a Monday morning. As for me, I'm locked in on Meta, down more than 4% in today's session. Why do I care about this one? It's pretty simple. It's the latest sign in the markets that the AI stock trade is fatigued. This stock, you're seeing it down close to 4%. Right now, near session lows. And really, let's keep in mind that this was a stock prior to today's session, up close to 40% year to date. Julie, of course, Meta, as part of that, really trade up in all things AI. I would call this a second derivative trade on the AI. You know, Meta, of course, is working on AI, but more so focused on Quest goggles, as Mark Zuckerberg recently talked about, again, bashing that Apple goggle. But for me, I think investors are going back to these AI trades and what they reported in the most recent quarter and really digging into, are these companies making money, and are they going to make up more money than people expect? And I went back to Meta's earnings, and I think investors are not realizing how much they're going to spend this year on Reality Labs and how that might impact their profit margins.
Well, I respect the fact that you're giving people credit for digging back into the fundamentals. I would submit it's probably more of a momentum trade, right? That we saw, and the momentum trade starting to falter a little bit, right? All of the momentum chasing that we've been seeing happen in the likes of NVIDIA, which is now continuing to roll over a little bit, in the likes of Meta, which is now rolling over. You know, a pause, or is it something more sustainable? I think that remains to be seen. The excuse today, at least, seems to be something that's been another theme in the market. Questions about the upcoming presidential election. What are the impacts going to be on the U.S. economy, on the markets? This is after former President Trump made some disparaging comments about Meta in the context of him coming out in support of TikTok not getting a different owner, which is
tomorrow,
something that
he may say something completely different.
He might, right? And who knows if that's really the reason that Meta is selling off on concerns about what would happen under a future Trump presidency potentially. Yep. But maybe it's an excuse.
I'll just add this. When I see this type of action on a Meta, that there might be a downgrade coming on the stock from Wall Street Investment Bank. Now, I don't have any knowledge that might happen. When I see this type of action after a big sell-off on like I saw on NVIDIA on Friday, tells me the banks might be getting a little worried, may come out with some downgrades in the weeks ahead.
Well, the folks over at JP Morgan, at least on a macro basis, led by Mislav Matejka over there, not getting worried, looking at the 5-year PEs of the Magnificent Seven versus where they are now. Meta, interestingly enough, is trading above its 5-year average.
They're all pricey.
They are not all
They
pricey.
are all pricey.
They aren't all
40,
pricey.
50 times earnings?
They're not all at 40, 50 times
No, I'm not
earnings.
saying all of them, but a lot of them are pretty pricey.
Okay.
I know you're looking. I know
But
you're looking
no,
at Chair. You're right to call
we got the numbers,
I
Sam.
got the numbers.
All right, Meta isn't the only mega cap seeing some losses. For more on the recent struggles from the Magnificent Seven and where investors should look to turn to outside of big tech, we want to welcome in Omar Aguilar, Schwab Asset Management CEO and CIO. Omar, thank you so much for being here. So as we see what looks like a faltering perhaps of the Mag 7, as well as a broadening of rallies elsewhere in the market, where do you think investors should be looking? You know, is it either or? Is it both? How do you think about it?
Well, that's a great question and very timely. I think as you were discussing this earlier, you know, the momentum trade started, you know, when everybody was talking about AI, you know, over a year ago. I think that momentum trade started to just be just a function of excitement, just a function of, you know, the investors getting really excited about the potential. I think as we go in through this year, you know, this has actually shifted from just being just a momentum trade to be a fundamental trade. And if you actually think so, earnings, despite the valuation numbers for these Magnificent Seven, has been significantly better than the rest of the market. So they have outperformed, you know, over EPS year-over-year growth of 60%. Whereas the rest of the market has actually been on a decline of EPS growth. So when you actually put that together with the fact that they also, you know, have had very consistent free cash flow yields, you know, that actually provides a lot of the support. Now, that's the past. The future, basically expectations required a lot of the discussion that you just had, which is a significant amount of ramp up of CapEx and R&D in order for them to support what the market expects they will deliver in the future.
And so Omar, isn't that the next shoe to drop here? That once these companies report in coming weeks, there's no possible way they can meet up to the expectations that have been priced into their stocks. So that's what investors are doing today, selling these positions.
Well, I think the investors are looking at the relative valuations. They're basically looking at it. It looks, you know, a little bit higher now compared to any other, you know, big, you know, runs in markets. You know, they're still not at the level of what we saw in the late 90s or even in the energy, you know, boom that we had, you know, afterwards. So, you know, still, you know, in that context, you know, it's really more about the function of, you know, the expectations over the next 5 years is that they will deliver 30%, you know, top line growth and 17%, you know, on EPS growth, which is very hard to sustain. So investors are questioning whether or not that's actually sustainable. And there are a couple of those seven that are in the process of ramping up that R&D and that CapEx that obviously may have a better future going forward.
Omar, I want to ask about CPI tomorrow, right? Because it has seemed in recent weeks that the focus has shifted a little bit away from the Fed and to earnings and to the AI theme. Does CPI tomorrow shift the focus back, or does it just depend on what the number shows?
I think, you know, in general, we should expect more volatility. I think once we got past the earnings season, you know, I think the question becomes, you know, the CPI reading is really just going to ask or give us a little more information on what the reaction function by the Fed might be. And it's really just about the timing where they may actually come up with the first rate cut. And I think investors will continue to look at opportunities to take that volatility, whether it's valuation driven or whether it's, you know, related to macro, to be able to rebalance their portfolio and strategically position for the next 6 months on an environment that will have lower interest rates on the short part of the curve.
If one is worried about the AI trade fizzling out, Omar, what is the best sector they should be looking at right now, and make your case?
Yeah, I think, you know, what we have encouraged, you know, our clients to do is to, you know, if you think about the economic cycle, you know, as we are today, even with the CPI numbers tomorrow, you know, we have all signed that this is the last phase of the cycle. What that means is that that soft landing scenario that the Fed has talked to us is basically now being a reality. And what that means is that the cyclical trade going into the next phase is probably areas that will basically provide good opportunities. And that includes materials, that includes energy, that includes areas that are a little bit bit more prone to lower interest rates, or at least a shape of the yield curve that is more normal, like financials. So I think we encourage clients to start looking at that. And we have seen already, small caps are incredibly attractive, and the rest of the market outside of just the large mega caps will probably do well.
All right, Omar, we will see what happens. Thanks so much. Appreciate it.
Thank you.
We're just getting started here on market domination. Coming up, it has been 1 year since the collapse of Silicon Valley Bank. And despite that shock being over for the markets, there are still concerns about regionals, especially NYCB. We'll discuss the sector later in the hour. Plus, Bitcoin soaring to new highs today. We're speaking to experts in today's playbook to help break down the best ways to consider investing in crypto. And the newest edition of our series, Goodbye or Goodbye. We'll get investor insight on 2 stocks to help you make the best choices for your portfolio. Stick around, more market domination still to come.
Investors are on edge ahead of tomorrow's inflation reading, and we're also seeing volatility on the rise. Yahoo Finance's Jared Blickery is in the newsroom with a closer look. Jared.
It's a subtle trend, and it doesn't happen all the time, but we are seeing the VIX rise with the S&P 500 on a couple different time frames. Behind me, I have the S&P 500 in purple. You can see having climbed that wall of worry over the last few months. And by the way, this is a one-year chart. And then in cyan, I have the VIX, and you can see this broadening megaphone pattern that it is tracing out here. And in fact, we've seen this happen before last year. And how did this end? Well, it ended with a decline in the S&P 500, and there's been a lot of talk about when exactly that will be. So let me get to the S&P 500 here. I'm going to put some candlesticks on. This is a 6-month chart, and we don't really have a lot of price history until we get down to about 4,800. And the reason is we've just been climbing this wall of worry, not a lot of volume having been transacted there, really not a lot of back and forth. So when price does correct, it tends to come down to an area where you've had some back and forth. So that's that area in the red box that I'm outlining right here. Now below that, you got the old highs, and we'll have to see what happens beyond this, but eventually we will get a correction, and so that kind of satisfies, hopefully, the potential for the levels that we would see. Real quick before I want to go, I was mentioning stocks and stock volatility. We've seen gold and gold volatility exploding to the upside, and let me see if I can get a gold chart in there. Might take me more than a few seconds here. Some error operator. There we go. Gold futures. What is this? Day 8 now. We've seen this explosion to the upside. And then here's the gold VIX. You can see that is elevated as well. So gold VIX actually good for gold prices going higher.
Well, we've seen them continue to go higher, so we'll see if indeed that bodes well. Thanks, Jared. Appreciate it. Now let's look at some of the analyst calls of the day, starting with Pinduoduo, the owner of the Chinese e-commerce site Temu. Those shares are bouncing today after Jefferies indicated it's a good time to invest in the stock. It upgraded to a buy. The price target, 157. Goldman Sachs, though, on the other side of the trade, lowering it to neutral. What's interesting here is Jefferies says that the bad news is priced in, the bad news being a lot of the political noise around this company, potential, sort of snapback against it.
Julia, I'm not even emotionally there. I get the call. I see where they're coming from. But if you want to play internet e-commerce, if that's your thing, if you're really excited about putting money to work in internet e-commerce, why don't you just invest in Amazon? You can understand the business. You can walk into a Whole Foods and go buy oysters and fish and whatever you want. They have a strong business in Amazon in the cloud services business. The retail business has come back strong. They're dominating in retail with same-day delivery services. Why not just go there? I get the call today, and that's fine, but I understand Amazon better than I understand a Temu.
What's not to understand? You make cheap stuff and you sell it.
But can you trust a business like this? And I still think this falls under the lines of Alibaba. What does an Alibaba really do? Do we really know what they do?
I mean, Temu seems more straightforward than Alibaba.
Is it? Do you trust the numbers? Do you trust the
But
company, what they're doing?
What do you even, where is this even coming from?
I have a hard time putting a lot of trust in these Chinese internet companies that have disappointed investors for many, many years. And I will just say that.
Okay.
Another hot call of the day. JP Morgan's Matt Boss raised his price target on Macy's $25 from $23. He kept an overweight rating, which is comparable to a buy rating for those taking notes at home. The JPM team has those bullish vibes after meeting with the CEO and CFO, saying the retailer is repositioning itself for better margins and sales growth for this year and beyond.
Do you understand this business?
I understand a Macy's because I could drive to a Macy's. I know what they're doing. So Matt Boss, really one of my favorite retail analysts on the street. And I find it interesting when he talked about these 150 store closures. Now, Macy's has not disclosed where these stores are closing just yet, only except 2 locations. What he notes here is that most of these 150 locations are pretty much awful, where Macy's is the lone anchor tenant inside of these malls that are dying. My critique here is for new CEO Tony Spring, who's been at this company for a long time. Why haven't these closed these stores 10 years ago?
He's been there, but he wasn't running the show.
But he's decision maker. And I have a Macy's by me on Long Island. There's nothing left of this mall. There's a Macy's out on Long Island, Massapequa, with a sign out in front saying,
that's one of the ones they're closing.
We're still open. I hope they do close it, because I think the whole mall should be bulldozed and then something else should be put there that is more economic growth friendly. The point being, these stores are not making any money.
You've got a lot of opinions today, Sass. What would you put there instead of the mall?
I think it should be a stadium, a sports stadium.
Who's playing there?
Anybody. But the point is, there's a lot of space there in Massapequa where that Macy's is, and it's just
All right,
we're fired up. All right, let's bring
today.
Yahoo Finance's Brooke DePalma into the mix. Brooke, I don't know how you're going to follow that one, but I know you've been covering the Macy's situation very closely, and you've been digging into this Matt Boss note.
Yeah, good afternoon to you both. Quite the hyped up crew here we got on set, but definitely taking a deeper dive into what exactly this means for brands. Brands hoping that maybe that Massapequa store is one of the good ones to move forward with. JP Morgan definitely dove into what exactly closing these 150 stores and leaving open the 350 stores means for brands like Ralph Lauren, like PVH, Levi, and Tapestry. And initially, JP Morgan really saying here that this protects the long-term viability of the entire store fleet while also allowing for reinvestment in those go-forward locations in alignment with these vendor partners.
It says they
so
want
basically
them to
doubling
do
down
this.
on those top-performing stores. These vendors really hoping to hopefully, get rid of those what Matthew Boss called those tail-end stores, those tail stores, and really double down on the stores that have those top-performing vendors and brands, those top-selling.
You know what you go in those stores? A big Temu warehouse manufacturer. There we go, right there.
Basically, what he's saying is that it's in those vendors' interest.
Exactly.
They want them also to close the doors. I also thought it was interesting that Matt Boss made the point that, you say, why didn't this happen earlier? Yep. He's saying that this was in the works even before Macy's came under activist pressure.
Yeah, and CEO Tony Springs said to Yahoo Finance, this ongoing bold new chapter strategy has been in the works for more than 6 months.
Right.
We know, though, that this activist shareholder, Arkhouse Brigade Capital, coming in with that $6.6 billion bid, and many on the street saying that Macy's is really seriously considering it here. Some even saying that Tony Springs will stay as CEO under this deal. And when we spoke to Arkhouse, they're really looking at it as both retail and real estate. That also caused lots of skepticism about what Arkhouse's real intentions here. They're telling Yahoo Finance they want both sides of the business here.
I know you know that mall that I'm talking about. And that's not a go. You don't have to say anything here. We can take it offline. Brooke De Palma, fab analysis as always. All right. It is a year on from the surprise collapse of Silicon Valley Bank. Despite the initial shock being over for the markets, the ripple effects are still being felt for regional banks, no more so than at stricken regional NYCB. The bank secured a significant funding raise of $1 billion last week, led by former Treasury Secretary Steve Mnuchin, temporarily alleviated near-term worries for investors about the entire banking space. But pros we talked to say the sector isn't out of the woods. Chris McGrady is KPW's head of U.S. bank research, and he's been looking into this. Chris, great to get some time with you. So you've been following this NYCB situation. Are there other banks out there from a regional perspective that investors need to worry about?
Sure. Thanks for having me back. New York community is very unique. I hate the word idiosyncratic, but this business model is very different from the average regional bank. Couple of data points here. They're entirely New York metro market focused. 60 to 70% of their book is multifamily commercial real estate in New York. And this has been an issue and a concentration issue for as long as we followed the company. If you take a step back, the regional banks, real estate's an important asset class, but the level of concentration that New York community has is different than every other bank.
And I want to linger on NYCB for just a minute here, Chris. It's Julie. You talk in your note today, you keep a market form, you talk about the shares being range bound. With that multifamily concentration, what does the new management need to do, right? Because I believe they've indicated they're going to keep at least some of that multifamily portfolio, but since a lot of it is rent stabilized, how much flexibility do they have and how can they optimize that portfolio?
Right, it's a fair question. The concentration issue is something that they're trying to address. Now, if they were to sell this portfolio, the mark they would have to take, given where interest rates are, would be capital destructive. So it would reverse tangible book value. It would pressure earnings even further. So you have to take a step back and say, what could they sell? What could they reduce? What could they take off their balance sheet? We estimate there's roughly 24 to 25 billion of loans that are on the balance sheet that could either be sold or securitized. And really the mark would be less punitive. Now it does increase the CRE concentration proportion on their balance sheet, but it's one step I think they need to take. And I think they're going to tell us more on that in April next month.
Chris, what's the case for an investor to even own shares in a regional bank? Because when you look at a Bank of America, a JP Morgan, these are fortress balance sheet type companies. Why not just own them?
I think you've seen that trade, right? If you think about the last 3 to 4 months, the regional banks, the small banks, the KRX, they've underperformed the BKX, which is the KBW top 24, by about 11 to 1,200 basis points. So investors are clearly making a bet that the larger banks are the safer play. Now, at some point, there will be a mean reversion trade. The valuations will be a little bit more off sides. But right now, investors are making that trade. And I think there's credibility with that. The largest banks have more diversification and they've got higher reserves. And so if you look at what's in earnings estimates, the largest banks have higher credit assumptions already factored in. So if the economy worsened, they'd have less earnings pressure than the small banks.
And so how are you thinking about where investors should look right now, especially given that sort of surprising commentary from Jay Powell last week that the Fed might be a little bit more flexible on capital requirements or on new capital requirements for the big banks.
Right, Basel III, the end game there, that's a big one. Certainly the largest banks would benefit if we got a watering down of Basel III. Regulation is something that's really important for the banks for good reason. Most of the regulation is good, but I'd say some of the proposals that are in place are really punitive. So those are the things. In terms of interest rates, higher for longer, that's our base case. We think rates will stay higher for longer. We think you want to own banks that are going to poised to do well in that kind of a scenario. Companies like East West Bank, Wintrust, Webster Financial, these are banks that trade at very low multiples, 8-9 times earnings, and the ROEs are in the upper teens. And so those multiples and the valuations should converge over time.
Chris, on the flip side, and to go back to something that you mentioned, if NYCB is idiosyncratic and those other banks you think are well poised and well valued right now, certainly there must be other banks that also have some idiosyncratic risk right now at a time when rates are still high, the Fed's not cutting yet. So are there other places that you're looking for potential risk at the moment?
Sure, we're looking pretty hard. The biggest concentration that we see on balance sheets is in commercial real estate. We've talked a lot about that. We've analyzed that in detail. Within commercial real estate, office is a segment that we're very cautious on. The banks are cautious on. And so, banks have 40% of their balance sheet in commercial real estate. We're looking at situations where maybe they do have the exposure, but they haven't grown the balance sheet nearly as quickly as others. So we don't believe in banks are being incentivized to grow the balance sheets today. So we really want to be careful, but there's really no rock that's been uncovered. Commercial real estate is where it's at.
Chris McGratty, KBW's head of U.S. Bank Research. Appreciate the time.
Great, thank you.
Still to come, the newest edition of our series, Goodbye or Goodbye. We'll get investor insight to help you make the best choices for your portfolio. Stick around, more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're focusing on what companies investors are currently betting big on with predicted long runways for growth and where there is not. I'm here with Chris Versace, Thematica Research Chief Investment Officer. And first of all, welcome to you. Thanks for being here.
Happy to be here.
See, I'm blaming the time change on everything everything that goes wrong today. Let's talk about your goodbye stock, and that is Marvell Technology. Now, the stock did have a pullback last week after its earnings, but let's get to why you like it here. AI and data center demand. First reason.
Well, let's start off by saying that there's a lot of different chip stocks out there. We tend to think about Intel, we tend to think about Qualcomm, but Marvell's a little different because its chips really go into the infrastructure that supports all the connectivity that we have. So when we think about the rampant spending on AI, or we hear from Google, Meta, Amazon, how they're spending on data centers, all that requires chips. And we know this from NVIDIA, who had stellar guidance. But guess what? Marvell did report last week, and their data center business was up huge. Like Donald Trump, huge type numbers, okay? There were some other businesses that didn't perform as well, but I think that as a result of the continued AI wave and what we're going to see as embedded AI comes to devices, smartphones, PCs, and really turbocharges the amount of data that we're consuming and creating, you're gonna see a rebound in the network and carrier spending, and that's really the second point.
In the places that had lagged.
Correct.
In that earnings report last week.
Correct.
Okay, so talk me through that.
So if we think about how our data gets moved around, it's not simply there it is, right? It has to traverse through a network, whether it's the wireless network, the fiber networks that we have, and there's all sorts of enterprise-related networking as well. So as this virtuous circle of data just explodes, not just because of ongoing 5G adoption, not just because of other applications that are coming, but really in the near term, this explosion due to AI, network spending is going to have to catch up. In the near term, what are we going to see? Network capacity levels will continue to rise as companies like AT&T, Comcast, Verizon try to hold off spending. But at some point, there's going to be a breakthrough wave where they have to upgrade their networks, because you and I are not going to be happy with subpar service.
Right, and that's interesting because it's not only predicated on the AI story,
Correct.
but on a bigger data story. And then finally, the stock had a monster run going into the earnings and then saw that pullback.
Yes, so like a lot of names that touch the AI space, the stocks had a significant run, not just so far in 2024, but really since the end of October. Priced to perfection, right? So not only did they have to deliver a great quarter, the guidance had to be stellar across the board. And as we saw, Marvell did disappoint, but that's actually opportunity for folks that have missed out. So we're seeing that kind of pullback now. They did one of the earnings playbook moves, I would say, which is we've seen companies that have delivered softer than expected outlooks either hike a dividend if they could or announce a big buyback. They announced a $3 billion buyback, and I think they're going to use that to support the stock.
Oh, interesting. Okay, so we always talk about the risk potentially here, and you've got two, time and market risk. What do you mean by that?
Well, time means that, we just might be a little early, right? I think ultimately this is going to happen. The timing that I'm thinking about is we start to see the first wave of these new AI-enabled devices happen in the second half of the year, ahead of the holiday shopping season, fostering this big upgrade cycle. I say this because, well, take a look at what we saw at CES 24, Mobile World Congress, and let's think about what Dell announced just 1-2 weeks ago about AI-enabled laptops coming to market. It's going to happen. And then market risk is just the market. If we do see the market pull back in a meaningful way, Marvell is going to come down.
Right, and we've seen that with tech stocks specifically. Do you hold Marvell, by the way?
Marvell is one of the largest holdings in the AAP portfolio that I manage for the street.
All right, good to know. And then if people are spending money on mobile phones and networking and things, something maybe they're not spending as much on is in a department store like Dillard's, which is the stock that you're
Macy's.
saying to avoid. Macy's, which we were talking about earlier. The stock's actually had a little bit of a rebound here. So why do you think that Dillard's is not going to benefit?
Well, a couple of reasons. One, if you take a look at a lot of the data that we see, and I'm sure others see as well, the consumer still remains very selective. They're not just willy-nilly spending. And I think that if we take a look at the consumer debt levels, because we just got the January Consumer Credit Report, wow, they really took on a lot more debt. So they're going to be even more selective going forward. So I just don't see folks flocking to department stores anymore. And the data shows that, right? So when we look at the next data point, in the last quarter, the holiday shopping season, department store retail sales over the trailing 3 months fell 4.7%. People are not going there. Worse, when Dillard's reported its quarter, they were down 5%. So they're losing share.
Right, and they're losing share too. Let's get to the next one here. Amazon and other sort of online retailers.
100%. If there was a stat that I saw that Amazon is 34.5% of all U.S. online retail sales. And if you go outside of online retail sales, they're around 15-16% of total total apparel sales. That's going to hit the department stores, square in the gut. And then there's Costco, which, believe it or not, and this number is just a little old, they're about $9-10 billion in apparel. So the competitive forces are circling.
Interesting, and more value probably compared with the Dillards. What would be the risk, though, to the upside here? Is that the economy ends up better than expected?
It's simply that the consumer is way stronger than we expect. Job growth surprised to the upside last week. Wage growth still a little bit better for job changers if you look at the ADP data. So to the extent that real wage growth accelerates, well, people have more money, they'd be able to spend more. I still don't think they're going to do it at Dillard's.
Fair enough. And do you have any position in Dillard's, by the way? Okay, so let's summarize your case here, and it really has to do with where people are spending their money. You're saying buy Marvell due to the company's strong financials and the growing demand for AI, but just for networking more broadly. On the other side, you say avoid Dillard's due to growing competition in the retail space and a more choiceful consumer. I believe that's how Walmart executives have put it. Chris Versace, good to see you. Thanks for coming in. Appreciate it. And thank you for watching Goodbye or Goodbye. Join us 3 times a week at 3:30 p.m. Eastern.
All right, let's head on over to the Yahoo Finance trending ticker page as the trading day draws closer to the closing bell. MicroStrategy topping our watch list. Shares are surging after the company makes its second largest Bitcoin purchase. MicroStrategy is buying another 12,000 Bitcoin, bringing the company's total Bitcoin holdings to approximately 205,000 tokens. The company's market cap is now an astounding $27.7 billion, mostly due to its sizable Bitcoin holdings. Shares are up 150% year to date. Julie, wow, and I think people would be surprised that originally this was a software company first. Now they're...
I mean, it still is a software company, apparently.
Kinda, but really they have built up these Bitcoin holdings, and for now, it seems to be working out, but that could change a drop of dime if we see a pullback in crypto.
Well, it was that way when we saw the pullback before. But I mean, the fact that they own 205,000 Bitcoin now is just a pretty incredible number here. What's also interesting is that they just sold debt in order to fund the purchase of this newest Bitcoin. So that's why if things go pear-shaped in the Bitcoin market, that could be even more troubling for them. But so far, so good, right? And there's a lot of predictions, and we're going to talk to a couple of crypto investors in a little bit. We've seen some big predictions based on the halving, based on continued demand for Bitcoin ETFs. One interesting thing that stuck out to me, the latest Bitcoin buy that MicroStrategy did, the average price was at $68,477. So we're right around there now. But the average price for the total holding is $33,706. So in that sense,
so Michael Saylor just
they're sitting pretty.
Of course, CEO of Micro he's not
the executive chairman now.
But it's still his ship, right?
Well, he's in charge of the crypto strategy for the company. And by the way, we're going to talk to him tomorrow.
I heard
on the show. So we'll talk to him about that Bitcoin strategy.
I'm psyched. All right, psyched about this one too. Moderna shares on an upswing as the drug maker starts a mid-stage study to test its experimental skin cancer treatment. Trial is in collaboration with Merck. And I remember we talked to Stefan Bancel, the CEO of Moderna, at the World Economic Forum, and he was talking a little bit about their pushes into cancer, but really trying to, I think, broaden this platform away from just vaccines. Yeah, just vaccines, but also just the COVID vaccine. I mean, they have to broaden it out 2 more products here. The stock is up about 13% year to date, but it's down about 24% over the past year because investors want that show me story, right? They want to see more vaccines. So the company is trying to launch an RSV vaccine. That's for that virus that affects
older adults, affects kids as well. And then they are also trying to try a combination flu and COVID vaccine. That's something in the pipeline. And then finally, there's this cancer vaccine, the skin cancer vaccine. They're developing it in partnership with Merck. So that's kind of what's on the docket.
I was looking at that stock chart on Moderna. Well, look how far it is has really come off its highs. And maybe that's where investors, if this AI trade is not going to work, maybe they do go back to healthcare and start kicking the tires on Moderna.
I mean, they never went anywhere when it came to Eli Lilly.
You're right. Well, I mean, they've been a beast. They've been killing it. They've been crushing it.
Yeah. All right. Now, turning to shares of EQT, that stock is dropping after the company struck a deal to acquire Equitrans Midstream. It's an all-stock transaction that aims to expand EQT's presence in the natural gas sector. And what's interesting here is Equitrans used to be part of EQT here, but we've seen sort of a re-verticalization within the energy industry. We've seen a lot of deals in this space recently.
I have no ponies in this race. So I will add it. To me, it makes sense that you would own the production and the delivery.
You don't think they should raise the pipeline and build an arena there?
Wow. Why
do I bring
Not getting a rise out of me. Not taking your bait today, Julie. No, I'm taking it.
There's nothing but rises out of
All right,
you.
we got Madison
All
Mills
right,
here.
let's get to Maddie Mills
I
here.
think you've got it. If you guys want to get into the fracking debate here, please feel free. I love it. This is great. No, but as you mentioned, Julie, and you bring up a great point about this, which is that the location of this pipeline, which EQT will now have access to after reacquiring Equitrans here, merging rather, is in a location that is going to be very critical. So first of all, this pipeline, which has been very controversial, is going to be able to deliver that natural gas from a landlocked area of Appalachia to other parts of the country. Think the southeast, potentially even out west moving forward. But right now we're focusing on the southeastern region, and this is going to open up a lot of supply for what the CEO calls the largest natural gas company in the country. And of course, it's that vertical integration play that investors love to hear about. As you mentioned, Sazi, they're going to own the format and the product. So that's
makes sense to me.
Potentially a boom for them, but not so much for the stock price. Maybe looking at the deals a little bit too expensive.
Well, it's interesting because the reason they spun this out in the first place was because of an activist campaign from JANA Partners back in 2018.
Yeah.
So it's interesting that they're now taking them on. Again, we've seen a bunch of other deals like this in natural gas, in oil, and it's become a refrain.
Well, and it makes sense given the AI boom that we're seeing. At least that's what the CEO said today. So maybe trying to get a little bit of excitement.
You're digging for that NVIDIA question, Madison.
Exactly.
You're digging for it.
Just if you mention AI, you're going to have a better day on the street. So trying to get
so much for EQT, though. All right, thanks, Maddie. Coming up, Bitcoin hitting another record high. So where does the asset, and does it at all, fit into your portfolio? How should you be investing in it? We'll tell you in our investor playbook next. Bitcoin hitting another all-time high after eclipsing $72,000 today. But the cryptocurrency has a ways to climb if some industry targets are to be believed. Yahoo Finance's David Hollerth and Josh Schafer are here to hammer this one. You guys have been trying to get to the bottom of how do they get to these targets. So first of all, let's talk about what are the targets and what people on Wall Street are expecting from Bitcoin.
So there's a range of targets here, Julie. Unsurprisingly, most of them are higher. I think most people that see Bitcoin going lower don't even engage in this exercise. I think that's sort of an important thing to start off with here. A lot of people that would say Bitcoin is going to go lower or have a quote unquote sell rating, as we often say, aren't even engaging in making a price target for the cryptocurrency. But some of the targets that we highlighted here, Standard Chartered Bank saying Bitcoin's going to go to 100,000 by year end. Skybridge sees 110,000 by year end. Fundstrat's Tom Lee has made a public call of 150,000 for the biggest cryptocurrency in the world. A lot of what these different firms seem to be highlighting is essentially it's a demand-driven product, right? We're really just talking about demand and how that's going to move price. The ETFs brought a lot more demand than we had previously seen for the crypto. There's not all the coins are mined, right? So as demand goes up, price is going to go up. It's a little bit of a basic scenario when it comes to that. David, you've covered crypto a little bit more closely than I have. I'd be curious just sort of what you make of what these analysts told us about the base case here and sort of what their reasoning was.
Yeah, I mean, there's like an element to this, like compared to S&P price targets, where it is a little bit more, there are more assumptions that are made. But when you actually dig into it, it is based around supply and demand, and there's some of that can be modeled, and these people are trying to do it, which it's still not easily done. And the interesting thing I think we found was just that there is a little bit of math and science behind it, and it's not totally coming out of nowhere as much as like some people think. But also too, it's it takes one or two more leaps than.
Yeah, well, it was interesting. ARK highlighted too, David, that they were telling me they use a top-down approach instead of a bottom-up approach, right? And you hear those types of things a lot of times in typical stock analysis, and top-down meaning that they're essentially assuming what the overall market size of Bitcoin could be by saying that Bitcoin is digital gold. So if we make that assumption, and gold is 1 to 5% of an allocation in a traditional portfolio, and Bitcoin were to replace that, you can start doing some fancy math. I can see Saz's head turning right now.
I was going to ask you for your price prediction.
On what that turns into for a market cap, yeah. And then that's how you sort of get the numbers. Yep. It's a big assumption to assume that we're all going to take our gold allocations in our portfolios and just turn them into Bitcoin.
Dale, I want to ask you, because you've been our guy here at Yahoo Finance covering these wild swings all the way down from the Bankman-Fried shenanigans, you name it. Does this time feel different? Does this feel like really this is crypto's moment and Bitcoin over 72,000 is just a starting point?
Yeah, I mean, I'm not going to invoke the magic words, but I think that the ETFs are definitely a unique place where it seems like there's like this buying demand for it. But, as we keep talking about supply and demand, at the end of the day, I think still the use cases are demand is speculative. And so we don't really know where that goes. And so I think there still is an issue of that when you're looking at like all cryptocurrencies longer term, but then obviously there's tons of believers who do see that, and one day it might be there, and who am I to say that? So as far as it being different, I would say I don't think it is different, but the market is very different. The demand is different. The use is about the same.
It's different until it's not.
Yeah, that's so true. All right, good to see you in person, David Hollerth. Appreciate it. Josh Schafer, always nice to see you as well. All right, the closing bell is fast approaching on Wall Street, but first we're looking at how to navigate the big picture with the Yahoo Finance playbook. As Bitcoin hits another all-time high, how much further the asset can climb is a hot investor debate. For a look at how to play it, we're joined by Dan Dolov, Mizuho America's Senior Financial Technology Analyst, and Matt Baunsweg, BitGo Managing Director, Head of Go Network. Dan, let me get over to you, because you've been covering these stocks for a long time, Coinbase, Robinhood, you name it, whatever it is. What are you telling investors at this moment?
Stay away. Stay away as much as you can.
Why?
It's in my view, it's still like I don't see the reason for people to. Let's talk about Coinbase specifically, right? They're a take rate business, and take rates are always bound to be kind of a race to the bottom. And eventually, there's going to be more competition, and they're already giving out pricing concessions. So in January they gave out a pricing concession for people who are trading 500,000 or above. So pricing pressure is starting, and competition is heating up. So I think the fact that I don't believe in the underlying currency, Bitcoin, that's one thing. But irrespective of that, I think Coinbase is that minus take rate pressure and competition.
And I just want to quickly follow to you, Dan, and before we get to Matt, because you do have, as I understand it, if I'm not outdated, a buy rating on Block, which obviously is a much different business, but also there is a crypto tie-in there. So is your buy rating sort of irrespective of the crypto side of that?
Actually, you're making like probably one of the best points ever. So
I didn't even know.
This is like a genius comment, because I'm old enough to remember that back in 2017 and 2018, and even 2019, the reason Block or Square at that time was performing so strongly was because of the correlation with Bitcoin in the last cycle. And guess what? It broke. And the correlation doesn't exist anymore. Does that tell you anything about Coinbase? It probably does. But on Square specifically, Bitcoin is like single-digit part of the revenue. I mean, 95% of the revenue has nothing to do with Bitcoin, and that's the reason I'm bullish on it. But by the way, same thing for Robinhood. I'm super bulled up on Robinhood, but not because of crypto, because of everything else, because of what they're doing in retirement, because of their growth in Europe, because of the leadership in equities and taking share from Charles Schwab. So this, Bitcoin and crypto is the least important stuff in my view.
Man, let me get you in here, because nothing goes up in a straight line. And if investors are getting a little worried about this move in Bitcoin, how fast it has come on, are there certain warning signs they need to be on the lookout for that there might be a pause in the cards?
I mean, you're seeing it right now. Yeah, sorry. Oh, sorry. I thought it was a question.
Yeah, that one for you,
Go
Matt.
ahead. Sorry.
Yeah, no, I think, look, I think you have to view this a lot bigger than any one specific company or any one, pullback or drawdown. This is a global shift in the way people think about portfolio construction. I think Pandora's box is now open entirely. Anybody can buy Bitcoin through their brokerage account. Institutions are starting to pile in through the 9 new Bitcoin ETFs. And the flows really don't lie here. There is demand for BTC as an asset. BlackRock through the IBIT ETF did $2 billion in volume yesterday. In total, the ETFs now hold over $55 billion in just their first 60 days of trading. So the flows really don't lie here. And even more importantly than just some of these short-term metrics around demand is you have two of the largest asset managers in the world in Fidelity and BlackRock. These are multi-trillion-dollar assets that have so much clout and weight on the market and can really drive what institutions do and how they think about their portfolios, endorsing Bitcoin. Fidelity the other day, put out basically 3 different core portfolio structures, all which recommended crypto as a percent of that portfolio. This has dramatic implications on how hedge funds, asset managers, the whole RIA market thinks about utilizing crypto in portfolios. And to me, this is just the early innings of that transition. So I do think, sure, could there be pullback, and if things get too hot? Definitely. I think we've yet to see retail really pile in as though they have in previous cycles. As funding rates start to become more expensive, as folks require more and more leverage, that will put pressure on the market. And I'm sure at some point we will have a pullback. But I think zooming out, this is really a generational shift in the way that crypto is going to be viewed institutionally and at the retail level.
Matt, what is the best way for investors to get involved if they want to buy Bitcoin? What are the relative merits of buying it through one of these ETFs versus investing in Bitcoin itself?
Yeah, I think, look, it's gotten a lot easier to get exposure to crypto and Bitcoin over the last few years. I think the floodgates are now open because it's extremely easy through the ETFs. So, there's a few ways. Obviously, folks need to consider, one, just the cost of, some of the ETFs, that are in existence. These can be as expensive as 1.5% if you're talking about Grayscale, or as cheap as 12 bips, if you're talking about some of the others. Other things that need to be considered are, who's the counterparty, right? Like who's actually holding the underlying Bitcoin here. And if you look at, ETFs like BlackRock and Fidelity, a lot of them are using Coinbase. BitGo is also another custodian that's starting to win some of the custody deals for a lot of the ETFs. BitGo obviously is a state chartered trust entity in both South Dakota and New York. So you do have to kind of look at the underlying, who's my risk to. But I do think, other ways to get exposure outside of this, the ETFs, are buying spot crypto yourself through one of the platforms out there. That could be BitGo, it could be Coinbase, it could be some of the other exchanges like Kraken or Fidelity. And then obviously investors can think about other things, whether it's, buying volatility, utilizing options or other derivative contracts such as futures. And then obviously there are other public equity proxies out there as well. Obviously Coinbase stock and MicroStrategy, or some of the minor companies like Hut 8 and Marathon. So there are now a host of different ways to take exposure to the space. But I think investors really just need to think about the actual volatility of the asset, the counterparty risk of who they're facing and the platform they're holding those assets on, and then what are the fees and costs associated with getting that exposure. So I would advise any investor to just kind of do their diligence in that sense.
All right, lots of power-packed analysis in there. We have to leave that one here for now. Dan Dolev and Matt Ballensweg, thank you both. We appreciate it. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for more market domination overtime.
There's the closing bell on Wall Street, and now it's time for market domination overtime. Brian and I joined by Jared Blickery to get you up to speed on the action from today's session. Let's see where the major averages ended up. We have the Dow ending around the highs of the session here, up about 47 points, only about 1/10% up here. The S&P still in the red on the day, down about 1/10%, and the Nasdaq Composite down 0.4%. That's as we've continued to see this large cap tech sell-off unfold in today's session, sort of continuing the action that we had on Friday. And Jared, it feels like the question a lot of people are asking here is whether this is a pause or a more profound break in that big tech bullishness that we had been seeing.
Yeah, exactly, Julie. And we were expecting a potential correction or at least a few percentage decline in the month of February, according to a lot of seasonality maps. Did not occur. We could be at the beginning of a new one. We'll have to see. But suffice to say, we are due. Now, let's go over the sector action for today. You can see materials is the number one sector, up over 1%, followed by energy, staples, utilities, and financials. Those are in green. To the downside, it's been industrials and real estate, both of those off by about 0.5%. And if we drill into some of the leaders and sentiment markers, it's been Bitcoin most of the day. That has been the headline grabber, and also gold. We have record closes in each of those. Not a lot of record closes in stocks or the indices to go around, but I'll just round this out by showing you what's been going on in semiconductors. There's not a lot of record highs to be spoken of when we have NVIDIA down a whopping 2%, Sazi.
All right, thanks so much, Jared. I appreciate it. Now, I'm watching Costco. Shares of Costco with gas prices at a 4-month high to $3.40 a gallon on average nationwide. You might be wondering, why am I watching Costco with this? And really, Costco operates 692 gas stations across the country. And the old rule of thumb is, as gas prices go up, Costco actually makes less margin on gas, and it brings their overall profit margin down. So something to watch, especially as Costco stock chart starts to break down after the company's earnings last week. Of course, they noted they sold a lot of gold bars, a lot of silver. Great, but profit margins under a little pressure, and I would be watching to see those margins on how those lower margins on gas sales impact their business. Now, Julie, the flip side of this is maybe they see a traffic burst because people are looking for cheaper gas, but nonetheless, something to watch.
I don't really have anything to add on this. I'm sorry.
Okay.
I mean, I know they reported earnings next week. I know people were disappointed with them. I don't know.
Cheap guess.
Yeah.
All right. While a lot of the buzz around the market action is about the AI trade and the decline in NVIDIA, there are still signs of exuberance in the broader market. Josh Schaefer is here with his takeaways from the trading action today. Josh.
Yes, I was just looking at our trending tickers list, as I like to do a lot of times throughout the day, and just sort of seeing what was up, what was down. And you noticed, you guys have highlighted throughout the show, the AI trade, not that hot today, not that hot on Friday. We saw NVIDIA down, Meta down, and a lot of what we've been attaching that AI trade to is that's where people are piling all their money, right? That's where the market exuberance is. That's where our quote-unquote bubble action is. Well, how about all these meme coins that are just taking off right now, and Bitcoin at a record high? There are certainly other areas beyond the AI trade that we're seeing investors take interest in that they also don't have necessarily a fundamental story to them, right? And it seems like people just have money to sort of throw at. I was also looking at BlackBerry today, up 10%. We know that's basically,
why?
That's a meme stock.
Yeah,
None of us have one of those phones anymore. Yeah. And so it's just interesting looking around and seeing, okay.
I definitely have one.
I never even had a BlackBerry, right?
Wow.
And yeah, there you go.
Out, Julie. This guy.
But it's interesting to just see some of the other moves of, just because the AI trade is slowing down doesn't mean that we can't look for a little bit of euphoria in other areas.
Good note. I know you're an avid consumer of stock research, Josh, and markets research. Good note from Savita Subramanian over at Bank of America. She's asking the question, what defines a bubble? And is the S&P 500 one? She's calling it this. 1, it's a gap between price and intrinsic value. 2, democratization of the asset class. And 3, rampant speculation. I get the AI trade has come on hot, but I don't think we're seeing rampant speculation there because the fundamentals in a lot of these cases do deserve it. I mean, look what the quarter that NVIDIA put up.
And the other thing Savita points out in that, right, is when a bull market ends is with widespread euphoria, right? Sort of adding to that point that you just made. And right now, what she pointed out and what a lot of other equity strategists have pointed out in the last week, we're really talking about exuberance in AI and exuberance in GLP-1s, right? That's most of the stocks that have driven this rally. And as you just pointed out, Saz, those are real stories. Like GLP-1s is a real story that is benefiting companies. It is something that is going to benefit the economy overall. Economists have argued, same with AI. It is a real story. Earnings are up over 200% for NVIDIA over the last year. It makes sense that the stock went up. It's when we start seeing it spread to companies that maybe don't have a pure AI connection or don't have a GLP-1 connection or maybe crypto, right? That's why I pointed that out, because that is a little bit of a spread of where people are looking to speculate right now. It's beyond AI. I don't think Litecoin has an AI application.
Well, but then the question, I guess, becomes is, okay, if the AI stuff isn't a bubble, if the GLP-1 stuff isn't a bubble, do the BlackBerries of the world become bubbly at some stage if they don't have that same fundamental case and just represent sort of like meme-ish chasing?
You would think so, right? And this is one of the charts we were talking about last week when we were talking about why so many strategists came out and said that we're not in a bubble. One of the things that Goldman Sachs highlighted was the number of companies that they viewed as stretched from a valuation standpoint. And there wasn't nearly as many companies that sit at that level as there was in 2021. 2021, when we think back to that meme stock rally, was a pure speculative bubble, right? There were companies that never saw profits and are never going to see profits, and their stocks are down 95% in the last 3 years now. We haven't seen the trade move to there yet, and I think when we start wondering where are the earnings for these companies have no profits, why is the stock up 80%? That's the speculative nature.
Josh, thank you. All right, we got to get to some breaking earnings news. It is from Oracle here. Oracle, third quarter adjusted revenue at $13.28 billion. That is right in line with what analysts had been anticipating. Our adjusted earnings per share, $1.41, $1.38 is what analysts have been looking for. And operating margin, it looks like, is ahead of estimates at 44%, 42.9% is what analysts had been anticipating. The shares, as you saw, are moving higher here. And in the statement, CEO Safra Catz highlighting large new cloud infrastructure contracts signed in the third quarter, which she says drove the company's total remaining performance obligations. That's another way that investors measure Oracle's performance, that those total remaining performance obligations were up 29% to more than $80 billion. That is a record for the company, and it seems like that's also one of the reasons that the shares are catching a bid.
Yeah, and this we were talking about it in the afternoon meeting, Julie. These past 2 quarters for Oracle coming into this report, this stock has been hammered on earnings day. So I am immediately now, just look at that market reaction, the shares strengthening. I am wondering, come tomorrow morning, is Oracle the type of quarter, the type of stock? Of course, it's an AI play. Does it reawaken the AI trade? That's how you have to be thinking about tonight and in the setup for tomorrow morning.
Yeah, and of course they talk about AI in the statement.
Of course they do.
So Catz talks about demand for our Gen 2 AI infrastructure substantially exceeding supply. So that's a refrain that we have heard from the likes of the chip makers, right, who say that demand exceeds supply here. And then the chairman and CTO, of course, Larry Ellison, saying this new AI-driven system that they have been introducing. He says in the fourth quarter, that's the current quarter, their fiscal current quarter, they'll start delivering their, what he says is a completely new ambulatory clinic cloud application suite. I don't know exactly what that means, but it's fancy in AI. He says it features an integrated voice interface that automatically generates doctor's notes and updates electronic health records, and that is an AI-generated system.
The most important word in that sentence from Larry Ellison is not necessarily AI, it is Cerner. Because that has been one of the biggest knocks on Oracle since it spent a lot of money to, in fact, buy Cerner.
He said that earlier in the sentence.
Yes,
I didn't quote that part.
I am looking at that statement from Larry Ellison. I'm thinking, finally, Oracle is starting to better integrate Cerner into its core cloud-based operations, and maybe they're starting to extract some value. A lot of maybes there, but again, some initial positive signs on Oracle.
Yeah, well, coming up, we're going to get an analyst take on those numbers as well to see if they are similarly impressed. Stay tuned. More market domination overtime after this. Oracle shares rising in the immediate aftermath of its third quarter results. Adjusted earnings per share coming in above expectations. That's $1.41 a share versus the $1.38 that analysts had been anticipating. Revenue also in line with analyst estimates at $13.28 billion. We also saw the remaining performance obligations at a record last quarter. With us now, Paul Meeks, Harvest Portfolio Management co-CIO and banking professor at the Citadel. Paul, it's good to see you here. So what do you make of these Oracle numbers? Also sort of emphasizing, not surprisingly, the AI upside for the company. As Brian Sozzi noted earlier, you know, the stock fell after the past two earnings reports, but now it's catching a bid.
It is catching a bid, and obviously this news today is, I don't know if it's wholly positive, if it's at least incrementally positive, because after the company announced its last quarter, it really took down estimates, and so did the street. And so you think about it, they came into the print today. Now the stock was up 2% in regular session. Now it's indicated up 5 or 6% after hours. But remember, the EPS estimates came way down to set a very low bar after they last reported. Yeah, I think there's some positive things going on here. However, I think that their legacy business is going to continue to dampen the overall growth rate. And even though they'll get some love with their AI capabilities and also OCI, their cloud infrastructure business that supports theirs and others' AI capabilities, you know, the legacy business is going to slow down that company, at least on a total revenue basis. And so I think over time, you have a compounded annual growth rate here of sales of about 5% and maybe earnings per share with a little bit of operating margin bump and more due to stock buybacks of 10, 11, 12. And it's better than it had been. And it's probably fairly impressive for a very mature snail growth company. But if I'm going to play AI, I would probably sell on Oracle's strength tomorrow. And as Brian says, if it does rekindle some excitement about AI, which has done pretty poorly over the last two trading sessions, I would rather buy those names.
Paul, good to see you, as always. Is there something fundamentally wrong with some of these AI companies that investors need to worry about that the market's trying to sniff out today?
Yeah, I think, Brian, that we continue to have a year or maybe even more, and I'm contrarian with this call, where we're just doing infrastructure build, large language model building, strongly in favor of the customized server companies like a Supermicro, and of course the GPU guys like NVIDIA and AMD, and then we'll have inference. And again, that tilts in favor of hardware and semiconductors. The thing that creeps me out that you're leading into here, Brian, is that I'm not sure that these AI apps from these software vendors will be as, they'll definitely be ubiquitous. I just don't know if they're going to be moneymakers. And so I don't know if I would put a lot of money into these follow-on, someday released, someday hopefully successful software apps that have AI embedded. I still would stick with the infrastructure because I know that's going to work. And I know it's going to work for the next couple of years. I don't know about the other stuff. There could be some cool products, but just like when we got on the other side of the .com bubble and when it popped, you know, we found that, hey, everybody has a broadband internet connection now, and it ain't that great and it ain't that profitable.
Well, and Paul, it's interesting to me when Oracle talks about this Cerner-led product that is a clinical digital assistant for doctors that makes doctors' notes and updates health records. Something like that is more an enterprise tool versus a consumer-facing app. You know, you have to wonder, will the former be more appealing, more profitable, what have you, than a customer-facing, than a retail-facing product?
It should be. And of course, you know, they grossly overspent $28 billion a couple of years ago for Cerner. And Brian is absolutely right. It's been a really bad deal very tough to integrate thus far, a real drag on the company. So yes, they're trying to kill two birds with one stone here, to talk up AI one and to talk up AI within Cerner, which so far has been a botched and very expensive deal. I'll kind of believe it when I see it, but obviously on a PR basis, and Oracle is very aggressive, always has been with their PR. Rates to be seen. I also know the major player in that space, Epic, because I've talked to a number of physicians, they're rolling out the same capabilities. This will not be anything too unique to Cerner, even when it is rolled out.
Paul Meeks, appreciate that contrarian analysis as always. We'll talk to you soon.
Yes, sir.
All right, Reddit is sharing more details for its long-anticipated IPO. Social media company and some of its investors reportedly looking to raise up to $748 million, targeting a valuation of up to $6.4 billion. Joining us with more is Kyle Stanford, PitchBook Senior Venture Analyst. Kyle, good to see you here. I've covered enough of these deals, and I imagine you have too. And really, you're getting the sense that enthusiasm is starting to build for this IPO, despite Reddit being another tech company losing a lot of money.
Right. Well, I think when you look at what's been going on in the market for tech IPOs over the past few quarters, which is basically nothing, anything is going to generate a lot of interest, right? I think, too, you've been talking about AI this entire show, right? And AI is kind of this secondary additive revenue stream that Reddit is going to build out, hopefully licensing their data, right? And that's a very, very interesting, really unique model that they're going to be able to build. And I think that just in total is generating a lot of buzz for this IPO.
Hey, Kyle, it's Julie here. So you cover IPOs. So I'm just curious, we're waiting for all of these IPOs. Where does Reddit stack up in terms of anticipation relative to some of the other ones we're waiting for?
Sure, right. Again, they're the first one out this year that's going to generate a lot of interest from the market. I'm not sure that you would say that they'd be more hyped up or interesting than maybe a Stripe or Databricks. But I think there's a wide range of variables that's going to make a company more interesting than another, right? So again, with Reddit being a long-held portfolio company, they went through Y Combinator in 2006, generating some interesting revenues. Obviously mostly been ads up to this point, but that huge AI hopeful revenue chunk moving forward, I think is a really interesting part of this. And so, with everything else going on in the market, Reddit definitely is capturing the interest of the market.
The 1.76 million shares, or close to 2 million shares, being allocated to users on the Reddit platform, how do you think that influences or might influence that first day of trading for Reddit?
Sure, right. It'll probably, obviously we've all seen what Reddit has done in some of the subthreads to, on the Wall Street bets and whatnot, right? But what they've done here is they've generated a lot of goodwill with their users, right? They're obviously, not trying to manipulate the stock, but making it, possible that their users are going to be more favorable towards this IPO and help talk it up. They're hyper aware of what Reddit subthreads can do for stocks. I don't think it'll have too big of an impact, though, right? Obviously, if things go south, that'll change and can change quickly. But I think it's a really good goodwill maker for Reddit, and to offering some of their longtime users and message boards managers, I think is a really good opportunity that they've taken advantage of.
Do you think other companies that are going public are going to do this kind of thing, or is it sort of idiosyncratic to something like a Reddit or a Robinhood, for example, whose users are so much part of the business?
Yeah, right. You look at what this company was built off. It was built off its communities, right? And so if you turn your back on that, that creates a very negative perception from those users that you are selling their information or selling their data off of, and are generating all of these discussion boards and building their reason for growing ad revenue, right? So, but again, we're not going to have many of these other companies that have built their company or that built their business model off of their users and community like that. So I think it's more of an idiosyncratic, opportunity here. Right? GoPro did it in the past. Obviously, they have a very similar model where they, took a lot of their users' videos and put it on for marketing campaigns of such. So this is not going to be a common thread for future IPOs into this year.
Kyle, you mentioned two other potential tech IPOs, Stripe and Databricks. I think people are familiar with Stripe, but what can you tell us about Databricks, and what should investors what type of research should they be doing today to better understand some of these potential IPOs?
Yeah, Databricks also is going to be another big pure play AI company, right? They raised a $500 million round last year, so I don't think they'll be looking to IPO this year. necessarily depending on the macro environment. But I think especially with those AI companies, looking at the subsectors within AI is very, very broad market, making sure that you understand where the revenue is coming from, what is going to be developed by these companies and generate growth over the next few years, and how that broader market is going to integrate these applications into all different sectors, across the business world. I think is a good place to start for investors looking at potential IPOs down the road.
Kyle, how important is profitability for these IPO companies at this point, right? Reddit doesn't make money, and of course it's had a down round. It's coming at a lower valuation than its peak. And presumably some of these other companies that are going to be coming public are not yet profitable. And investor appetite for that kind of stuff has sort of waxed and waned. Where are we on that front?
Yeah, no, I agree. Obviously, since really the beginning of 2022, profitability has been the major buzzword in not just the IPO market, but also in venture as well, right? And a lot of these companies that have pushed out their IPO or should have probably IPO'd by now are looking to regenerate their business model and make sure that they are coming to profits, right? Klaviyo and Instacart are two really good examples. They didn't have necessarily the probably reception in the public markets that they were hoping after moving towards getting to that profitability. So we will be looking at Reddit here as a company who is losing quite a bit of money, $90 million, I believe, in net loss last year. They have stemmed that a little bit, but it's not near profitability. So if investors are not ready to accept those types of companies, I think we will still see this closed IPO window for some time, because there's probably not too many VC-backed companies that are able to just switch on that profitability like they were hoping.
Kyle Stanford over at PitchBook. Good to see you. Talk to you soon.
Yeah, I guess you. Thank you.
All right, time now for what to watch for Tuesday, March 12th. Starting off on the earnings front, Kohl's, Manchester United, and Guess all reporting tomorrow. Kohl's announcing fourth quarter earnings before the opening bell. Tomorrow's report will give a glimpse into how much market share the retailer is likely losing to off-price chains, including TJ Maxx. Shares of the struggling retail chain have already started to slow this year, which is down about 3% on the year.
And moving over to the economy, consumer price index data for the month of February will be released in the morning. Economists expecting little change from January's numbers, but Wall Street is still keeping a close eye as the report provides another key piece of economic data as the Federal Reserve approaches its second FOMC meeting of the year next week.
Staying with the economy, the monthly U.S. budget for February is coming out in the afternoon. The deficit likely falling a bit from last month's budget. This coming against the backdrop of President Biden's $7.3 trillion budget proposal for the 2025 fiscal year.
And of course, sort of zooming in a little bit more, everybody's going to be watching that CPI report.
Yes.
We've got special coverage, by the way, beginning at 8:30 a.m. tomorrow morning on that. Why is this print so important? Well, it's so important, of course, because January came in a little hot. A lot of economists stepped back and said that was a blip. We are not going to continue to see those types of hot inflation prints. And indeed, when you look at this number, that's what's expected, it's not going to show any kind of reacceleration. At least that's not what economists are expecting. I'm looking at a report from Bank of America economists who say that the February number that we're going to get tomorrow morning should keep a rate hike for June on the table, potentially.
Interesting. And I'm looking over a new note I just got from Goldman Sachs. That team over there saying we see further disinflation in the pipeline in 2024 from rebalancing in the auto, housing, rental, and labor markets. Interesting note by them. My auto insurance, for example, it just keeps going up. I wish it would come down. Please disinflate. Geico. You're watching this. Come on, give me a break.
Yeah, and of
prices.
course, you being Brian Salzi, though, you're not only watching CPI, you're going to be looking at one retailer out numbers tomorrow.
And I will be watching Kohl's earnings tomorrow, a company I always like to watch quite closely. Kohl's earnings likely to be under pressure here. Sales, if Macy's results were any indication, might not be good for Kohl's. Of course, Macy's saw down sales across the board. Curious to see what Kohl's has to say.
Yeah, that'll be interesting. I don't know if they should close any stores, put up any.
Well, they've been
down some shopping centers.
Kohl's has been way behind it. This is a department store still operating over 1,000 stores.
Really?
You need over 1,000 stores. You do not need over 1,000 Kohl's stores. You just don't need it. You don't need it.
You don't need one. I'm going to quiz you and see if you know this. Which department store retailer has the highest number of stores in the U.S.?
Are you leaving out TJ Maxx, Marshalls, all of them?
Not
They not department
necessarily.
stores. Kohl's is up there. After this latest round of Macy's store closures, 150 stores, Macy's will have only about 350 Macy's stores in the United States. That's not
counting
a lot.
Bloomingdale's.
Not counting
but
Bloomingdale's.
still, there aren't that many Bloomingdale's either.
That's correct.
Interesting. All right, I knew I could get you with that one, that you would know. All right, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. Stay tuned for more Yahoo Finance on the other side. It has been 1 year since the Silicon Valley Bank collapse, and some venture capitalists, remember, contributed to the run on the bank by encouraging portfolio companies to pull out their funds. In turn, the bank's demise led to worries about where the valley would go to service startups financially. Here to help us dig into lessons we've learned from the SVB collapse and to talk about his new book, Time Is Now, A Journey to Demystifying AI, is the CEO of Single Store, Raj Verma. Thanks for being here, Raj. It's good to see you.
Good to see you too, Julie. Thanks for having me on.
So
I appreciate it.
We talked 1 year ago, and you expressed very firm confidence that startup culture was going to be fine, that the Valley was going to be fine, that it was going to survive. Because at the time, there was quite a lot of doom and gloom on that front. How have things changed, though, in the past year since the collapse?
Yeah, I think I was listening to the show before I came on, and I do think that the emphasis on growth at any cost has subsided. I do think that investors are looking for a leveraged growth model, and I think the companies are resorting to working on profitable growth, etc. So I think that's a big change in the Valley, or globally, I would say, in the last 12 months. I do think that there isn't a dearth of capital. However, only the good companies are being able to raise capital versus a scenario in 2021 where even a mediocre company could probably raise capital. So for sure, it's harder to raise capital now than it was probably 18 months ago, or in fact, 2 years ago. I do think that the opportunity of generative AI is the biggest opportunity in my career that I have seen, and I've gone through, quite a few these technological enhancements in my career, internet, cloud, all the rest. And I think this is going to be bigger than all of them put together. So still very, very interesting companies in the Valley. I do think that the growth at all costs has gone away, and more fiscal responsibility has crept into the businesses, which is good. I think only the good ones would survive, and that's always the laws of physics, so as to speak, and it's coming true.
Raj, you mentioned, to your point, there's a lot of upstarts, a lot of startups focusing on various parts of AI. Do you expect a wave of consolidation over the next 18 months as some of the bigger players in the tech space, flush with cash, start to pick out which companies could be the ultimate winners and are willing to buy them?
I don't think there's going to be a consolidation in the generative AI market in the next 18 months or so. Is there going to be a consolidation in the next 3 years? Probably. I do think that people are going to go have at it in the generative AI space. Understand it's also evolving. It's in its infancy. It's 2 years into this entire generative AI boom. And I'll ask you to reflect back when the cell phone was invented, what did the mobile phone look like in its second year? It looked like a brick. It was probably the size of my hand and had a battery time of less than an hour. So that's where we are in the ultimate landscape of generative AI. So I think consolidation, it's too early for consolidation. I do think that there'll be a lot of money and a lot of research that's going to go into generative AI. I think we'll all benefit from it, but I think consolidation is a little more than 18 months away, Brian.
And the companies that are starting up now or that are still fairly fledgling, just to go back to the sort of funding question and Silicon Valley Bank and bank servicing question, do you find the behavior has changed in the Valley in that company? I mean, even though there is a version of SVB that still exists, companies maybe have learned some lessons, maybe are not banking, everything in one place, for example. Have you seen that kind of change?
Oh, 100%. I don't know. I mean, we all CEOs of private startups, so most of us hang out occasionally, at least, if not more frequently. And we were saying that one of the biggest lessons that we learned from this, we at Single Store were just fortunate that we had multiple banks because we were flushed with cash. So we didn't want to put all our eggs in one basket. And that's why I happened to sleep a little better than most other CEOs on that weekend about a year ago. However, I don't know of any startup founder which does not have an alternative bank, so doesn't have at least 2, if not 3 banks that they bank with now and have optionality. So that's probably one of the biggest learnings that we CEOs had out of the SVB crisis. And also to understand that SVB was a very good line of credit provider, so as to speak. There is no dearth of credit in the market right now. And companies are able to raise debt. Reasonable companies are able to raise debt. So I don't see a paucity of capital, both credit and equity capital. Credit is, that one-time ARR ratio, whereas equity, there are more discerning investors now than they were about 24 months ago, Julie and Brian.
Well, hopefully that makes for a more healthy ecosystem. I wanted to switch back to AI here. As we mentioned, you're coming out with a book next month on demystifying AI. And I'm hoping you can help me demystify or clarify a current debate that is going on that's highlighted by 2 prominent individuals, Elon Musk and Sam Altman, on whether generative AI in particular should be on a so-called open system or closed system. And I'm just wondering, as you watch that play out, what you think the answer is.
I do think that the answer is somewhere in the middle. I think both of the parties are trying to hopefully accomplish the same thing, that there is a democratization of AI, and AI is not the privilege of the few. So from that concept, whether it's open or closed, I do think that I agree with the democratization of AI. Now, what does democratization of AI mean? That everyone should have access to AI platforms. At what cost and what optionality they should have is up for debate. I do think that at the end of the day, for a AI platform to survive, it has to have the ability to be monetized. And I don't know how open platforms, which are not have some layer of closed source in it, can be monetized effectively over a period of time. And if it cannot be, then there isn't a business model. That's exactly what we were talking about. And also, if it is a completely open business model, how do you prevent that from not landing up in the hands of the people we do not want it to land up in? So that's a huge debate. And I do think that the survival for an AI platform would have to be having a layer of closed source in it. However, I do think that certain level of democratization by making it available to the masses is required. So as I said, the answer is somewhere in between, Julie.
All right, Raj, great to catch up with you. Really appreciate it. And I'm sure our conversation will continue on this topic of AI. It's not going anywhere. Raj Verma, appreciate it.
Thank you very much. Great to see you, Julie and Brian.
Coming up, President Biden delivering remarks on lowering costs for Americans as he unveils his budget proposal for fiscal year 2025. We'll give you the details of it on the other side. President Biden has unveiled his latest budget proposal for fiscal year 2025. Here with the details of it, Yahoo Finance senior reporter Jennifer Schonberger. So, Jen, give us the highlights.
That's right, Julie. President Biden unveiling a sweeping $7.3 trillion budget today, increasing federal spending on everything from housing to childcare while raising taxes on corporations and the wealthiest Americans. With home prices sitting at 40-year highs and housing affordability becoming increasingly difficult, the president is proposing a new mortgage relief tax credit for middle-class first-time home buyers of up to $10,000 over 2 years. To unlock starter home inventory, the president's calling on Congress to provide a one-year tax credit of up to $10,000 for those who sell their starter home. And the budget also provides $10 billion in funding for a new down payment assistance program. At the same time, childcare costs have been rising, and there the president is proposing creating a new program under which families with incomes of up to $200,000 per year would be guaranteed affordable childcare from birth until kindergarten. So in essence, universal preschool. The president says with most families paying no more than $10 a day. The budget also increases employer-provided childcare tax credit. Now, the president plans to pay for these outlays and others, including lowering prescription drug prices and college costs, by raising the corporate tax rate to 28%, quadrupling the tax rate on corporate stock buybacks to 4% from 1%, and also with higher taxes on the top 1 to 2% wealthiest of Americans. Now, the budget would cut the deficit by $3 trillion over the next 10 years, while raising tax revenue of nearly $5 trillion. That's about 7% higher than what the government is currently racking in absent these policy proposals. And Julie, as you guys know, this is more of a wish list that the president is putting forth to Congress as Congress continues to struggle with current year funding and will likely end up being a blueprint for what he wants to do in his second term if elected as president. Back to you.
Jennifer Schomburg, good to see you. Appreciate it. President Biden's EV policies may be on the chopping block if former President Donald Trump wins another term in November's election. Yahoo Finance's senior reporter Praz Subramanian has the analysis for you on this one. Praz.
Hey, Ryan. So Trump this morning was on CNBC talking about EVs, among other things, and said you can't just go to electric, among other things, talking about how he's for electric cars, but he thinks that the time is not right. We need other alternatives. He complained about they don't go as far, they cost too much, all made in China. You know, whether these things are true or not is one thing, but a lot to unpack here. He also complained about the grid, saying that it's obsolete and a disaster in his type of hyperbole there. But complaints about the grid and also charging are not new, right? That's something that people have been talking about. The big question is what might he do about this? And he might try to defund the IRA tax credit as part of the Infrastructure Reduction Act. I'm sorry, the Inflation Reduction Act. And then there's the Bipartisan Infrastructure Act that funds the charging network. So those are the two big things that he could actually try to roll back if he wins the election in November.
Well, reportedly, he is trying to court Elon Musk as a potential supporter, donor, endorser. Would Musk be happy if he got rid of all that stuff?
Well, yeah. I mean, they asked him about Musk, and they supposedly met over the weekend. Trump confirmed this, and he said that I've been friendly with him over the years. I've helped him when I was president. I've liked him. So the question is he going to now then turn back these policies that are so beneficial to Musk and Tesla? If in the fact that Musk does support him financially for this run this year, hard to say. But I mean, he did say that we do have opposing views on the minor subject of electric cars. Clearly, they do. I can only imagine if Musk does support him.
The minor subject, the thing that the other guy, that's his whole job.
Direct quote, yeah. I can only imagine if he does support him, or if Musk does support Trump, I have to imagine there'll be some sort of give and take there with EVs.
Praz, really zoom out, and this year is shaping up to be the return of the hybrid. I looked at what Dodge just came out a couple days ago. Gas-powered, charger, but also an electric one. I think that gives a glimpse on where a lot of car makers are are looking right now.
Yeah, you know, I spoke to Stellantis CEO Carlos Tavares a while ago, about a month ago, in a room, like a roundtable discussion. He talked about how they want to make these multi-platform energy type vehicles where they can actually have two vehicles that have one gas-powered powertrain, one EV powertrain, because that's kind of like where they want to be in the future. They don't know who's going to win next in November. Depending on who does, they can kind of pivot based on what kind of policy standpoint is going to be in place there after the election. So yeah, definitely the automakers are looking at that.
Well, and consumer tastes have been changing too, so that way they're ready for whatever happens on that front. Interesting.
Russ and Marini, thanks so much. Appreciate it. All right, coming up, credit card and auto loan delinquencies are rising above pre-pandemic levels. We're talking the latest state of the consumer on the other side of the break.
2024 is really a critical year. This is a year of execution.
Culture eats strategy for lunch, but I think you need to have a strategy for culture. The culture that we have at Under Armour is one of grit, of determination, of belief.
OMSOM is all about being proud and loud. OMSOM is our true energy and ethos and spirit.
Our vision is to create a world with zero crashes, zero emissions, and zero congestion. And I'm excited to show the world what we can do.
Consumer credit is on the rise, growing 4.7% in January. This comes as credit card and auto loan delinquencies are still rising above pre-pandemic levels, according to the New York Fed. Here with more on the dubious health of consumer credit, let's bring in VantageScore CEO and President Silvio Tavares. Silvio, good to see you here. Help us make sense of where the consumer is right now, just based on the credit data you're pulling.
Brian, thanks for having me on. The really important key point is that the consumer is actually pretty healthy. We measure credit health by the average Vantage score, and that average Vantage score is 701 through the end of January. It dropped a bit of a point mid-year last year, and you could see the credit health deteriorating. But now the average consumer is doing really well. But what that masks is a little bit of a separation between consumers. That Vantage score prime tier, which starts around Vantage score 620, that's the main area where banks are lending. That tier is shrinking. We're seeing people go up or out. Some are dropping into Vantage score subprime, and others are actually going up into Vantage score super prime. And that has some pretty important implications for lenders, but also some pretty important implications for an election season.
What are those implications, Silvio?
Well, I think the key point as it relates to banks is banks have to be more picky. If you look at Vantage score consumers dropping out of that prime tier and dropping into a lower tier, that means you really have to be careful about who you're underwriting to, because you don't want those delinquencies that you just referenced increasing. But at the high end, for those consumers that are actually going up into the super prime tier, that's great news, very creditworthy consumer. But the challenge is all banks want that consumer, and so they're competing more aggressively to get that higher end consumer. It means more cost to acquire that customer if you're a big bank. So more competition at the high end and more risk at the low end is how banks are looking at it. If you're a politician and you're looking to get elected this November, either in the House or in the White House, what it means is your political message has to be attractive to both ends of the spectrum. That's hard to do because you're catering to folks that are doing really, really well and increasingly well at the high end, and also some consumers that are under pressure, continued pressure because of those sustained high prices due to inflation, and also sustained high interest rates, making credit more expensive.
Well, I wanted to get you to dig into a little bit more where you're seeing the pain amongst those consumers that are falling into the subprime category. You mentioned some of those pressures, but kind of specifically, or as specific as you can be, what are we seeing happen with those folks? Why are they falling down?
Well, the real reality is that the average consumer falling out of the prime tier is a consumer that's generally younger, that is generally less affluent, typically doesn't own a home. And those consumers have less of a cushion to weather the economic shock. The reality is, if you look across consumers, overall, they're doing well, but this segment is struggling. And it's struggling not in just one type of loan, let's say credit cards. Delinquencies we're seeing increasing for credit cards, for auto loans, for personal loans, for mortgages, really right across the board. And it's not just getting worse from a month-over-month basis if you compare January to December. It's also getting worse if you look at it on a year-over-year basis. So the credit deterioration is quite broad-based across all credit products, and also across all credit vintages when the loan was made. And of course, that's a sign for concern. It's a gradual worsening. It's not happening all at once. But of course, when you see that kind of broad-based deterioration in credit quality, of course, that's a cause for concern, and we're watching it very closely.
Silvio, should we get a couple interest rate cuts this year, do you see consumers going back to spending beyond their means?
Well, I think the reality is that we look at the year, and this approach that the Federal Reserve has taken of really staying the course and engineering that smooth landing, that is actually working. And so that's great job to the Federal Reserve. But I think the reality is, if you look at the year to come, there's definitely some cause to concern. There's going to continue to be pressure on the consumer, including the low-end consumer. Also, specifically around student loans, we're going to see that younger, less affluent consumer come under pressure. So I think the rest of the year could be pretty bumpy. Federal Reserve, I think, is probably going to make one cut, but even that cut, I think, is under question because there is pressure. But the reality is the economy, as I mentioned at the top, is still doing pretty well, and the overall average consumer is doing pretty well at an average Vantage score of 701. So we're watching that. I think we're all going to be watching the high frequency data on a monthly basis to make sure that we're not missing anything.
Indeed, and we'll have you back to go through that. Silvio, good to see you. Thanks for joining us.
Great to see you again, Julie. Thanks for having me on.
And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
Bye. Yeah, you too.